Larry, today a little bit of interesting action. Anything we should take note of or just some kind of choppiness?
Yeah, I mean, really deeply fascinating day, given that 10s traded in a 4 basis point range. 5-year break-evens, the lowest level since early February. 10-year break-evens are right behind them at March. And I think the name of the game right now is inflation compensation. And when you have a Fed speaker like Bullard, who is also a voter, saying that he could see a rate cut if inflation doesn't pick up, but I think the proof is in the pudding right now.
So you think that markets, because this is interesting, right? Because we've got a lot of commentary coming from Fed this week. We had, Bostic, Harker. You mentioned, what's going on across the speakers. This evening we're going to get, Mr. Jay Powell as well. That's all before FOMC minutes. Do you think the jawboning about getting closer to an actual rate cut is going to start to build up?
Yes, and I think the data might not be suggesting that, but I think the market action is suggesting that. When you have 5 and 10-year break-evens doing what they're doing, they're pointing to that. When you have the fact that credit spreads, even if you go out to CCC, I mean, they're still 200 to 300 basis points away from where they were back in December when we were all very worried. Why is that? And I don't know, I'm not a voter, but I think it might be because people just are, it's prerogative if the Fed's going to do something, or at least put the language in there that a rate cut will be coming if inflation doesn't rear its head.
Yeah, this is, I think, one of the most important questions right now because I said this earlier today on Twitter as well, and I know you've been following as we've talked about it, this December cut phenomenon, which is, for the stocks perspective, it's like the bullish case right now is basically, well, tariffs and volatility are fine as long as it's going to introduce enough volatility basically to cause the Fed to use the market as, their input and cut rates. So then you can have, the multiple buoy on stocks without any earnings. All right, fine. As crazy and twisted as it may seem, it's a fairly consistent logic based on what we've seen lately. That being said, though, do you see any sign that bond markets are still maybe ahead of themselves? What's going to happen when the information actually gets here? Let's say we do start to get that jawboning. What happens to 10-year bonds?
Well, I think it's going to continue to press towards the low end of its range, and we're not that far away from it, actually. I mean, 2.332, I believe, is a 2019 low yield, and we're dangerously close to that. But beyond that, not 2-spot flat, but 2.1 might be that next level. But that's if the market really believes that we'll see that cut. And by the way, it really does have a lot more to do, or equally as much to do, with what happens to RMB, the offshore currency that everybody's monitoring and worrying about, and also what happens to Eurozone growth, because we're so tied into that right now.
Yeah.
I mean, at least on the 10-year part of the curve.
Yeah, no, I think that's totally true. I mean, the data here has been just continued kind of lukewarm, right? You look at employment, you love it. And if you look at other things and some of the manufacturing measures, maybe you get a little bit concerned. But what I'm still having trouble with, Larry, is if does the market really believe that the Fed is going to do this? Because then if the Fed does do it, then you would think, okay, it's already been priced in, right? Because we're at 80% plus for December.
Yes.
So then maybe you think, okay, maybe there's a lift off, But the question of how bond markets actually respond to such an event, I don't know. I could see the bullish case on bonds, and I could see the bearish case on bonds.
Yes, no, precisely. I could too. And the 10-year would be the big mystery, because it really does depend with what happens with, especially with Germany, with the Bund yields there. We're very rich relative to the rest of the Eurozone right now. So you're right. I mean, it might be, it's already priced in, and we could back up to 2.556, 2.60. I could definitely see that. Why not? It's really the short end of the curve that will be most affected, and actually it's priced in as we speak, that the Fed will eventually cut rates. And I think that's why VIX is trading at 17, not 35. That's why the MOVE index is at 50, not 70. And that's why corporate yields aren't as wide as they were, 300 basis points narrower than they were back in December, because people are assuming that this will take place.
I think this is a really good point, Larry, because This is why your statement, I think, about watching the Euro data and other data becomes important, because if the impetus for this event is largely coming still from around the world and not some deterioration of the data, maybe that gets us closer to an answer on how bonds respond. Because if our data goes south and Fed cuts, then I could see the bullish case for bonds, because, you know, basically it signals that the economy is on the brink. But if it's anything besides that, then maybe that's not the scenario.
Yeah, I mean, it's all in the messaging, and it's really almost that simple. And the fact is, we're awash in capital. It's not evenly distributed around the globe. It gets frozen in niches, and if the message is right, then that part of the market will get untethered, as it were, and we could see 10-year yields rally back to 260 or drop down to 2%. It's all in the messaging. It's going to be really fascinating to see what happens over the next month or two.